Let's talk about a corner of the ETF market that's generating a lot of buzz. The high-yield, options-based ETFs like ULTI, PLTY, NVDY, YMAX, and YMAG. These are part of the YieldMax ETF family, and they've been grabbing attention for one simple reason: eye-watering yields, often advertised north of 30%, 40%, and in some cases even 50% annually. Today we're diving into the truth behind these monster yield ETFs, starting with ULTI, the YieldMax TSLA Option Income Strategy ETF, and unpacking how these products work, how they generate income, what risks are lurking beneath the surface, and how they compare to their cousins like PLTY, the Palantir version, NVDY, NVIDIA, and the broader YMAX and YMAG ETFs. And most importantly, is this real income, or a trap that erodes your capital? This is going to be a long-form, deep-dive breakdown, because the YieldMax ETFs look simple, but under the hood, they're far more complex than just dividend machines. Let's dig in. So what exactly is ULTI, and why are people flocking to it? ULTI is short for the YieldMax TSLA Option Income Strategy ETF. It's an ETF that's designed to generate monthly income by applying a synthetic covered call strategy on Tesla, one of the most volatile and widely traded stocks in the world. Let's break that down. ULTI doesn't hold Tesla stock directly. Instead, it uses synthetic exposure through derivatives, swaps to be precise, to mimic holding Tesla. Then it sells call options on that synthetic position to generate income. The premiums collected from those call options are distributed monthly to shareholders as cash flow. So essentially, ULTI is trying to capture the volatility and liquidity of Tesla, turning it into an income stream without requiring the ETF to hold Tesla shares directly. And the result? Monthly distributions that can range from 2.5% to 4% of NAVI per month. Annualized, that can mean 30% to 50% yields, or even more depending on volatility. Sounds amazing, right? But here's the first warning sign: capped upside, real downside. Because ULTI is selling call options against its Tesla exposure, it's capping any potential upside. If Tesla stock soars 10% in a month, ULTI's return won't match that. It'll collect the premium from the options it sold, but it won't participate in the full upside. That's the basic trade-off with any covered call strategy. You give up growth in exchange for income. The more volatile the underlying stock, the juicier the premium, but the more upside you're sacrificing. And with a stock like Tesla, which can swing wildly both up and down, that trade-off becomes more extreme. If TSLA rallies 20% in a month, ULTI might only capture 3% of that in premium. If TSLA drops 20%, ULTI takes the full hit, so in good months, you get a fraction of the upside. In bad months, you eat the full downside. What about PLTY, NVDY, YMAX, and YMAG? ULTI is just one part of the growing YieldMax ETF suite, which now includes PLT, same strategy, but on Palantir NVDY, focused on NVIDIA AFLI, based on a firm YMAX, a broader ETF that sells calls on a basket of top tech stocks, YMAG, similar to YMAX but optimized differently. All of these use the same basic structure: synthetic exposure plus actively managed call writing equals sign monthly distributions. And again, they don't hold the underlying stocks directly. These are derivatives-based products relying on counterparty swaps and daily rebalancing to maintain exposure and reset their call strategies. That matters a lot for both risk and tax treatment, which we'll get to. What's driving these huge yields? And are they real? Let's be honest. When you see a 45% yield on an ETF, your BS detector should go off. But in the case of YieldMax ETFs, the yields are technically real. They're derived from actual premiums collected via options. These are not leveraged products, and they don't borrow money to juice returns. Instead, they rely on something else: implied volatility. Tesla, NVIDIA, and Palantir are all high volatility stocks. That means the market is willing to pay big premiums to buy options on them, especially calls. These premiums are what YieldMax ETFs are harvesting. So if Tesla options are rich, and they usually are, ULTI collects fat premiums every month and pays most of that out. But here's the nuance: just because the distribution is high doesn't mean the total return is high. In fact, the total return might be flat, or even negative, if the underlying stock is trending up and your ETF is capping gains, or if it's trending down and you're taking losses on the synthetic exposure. How have these ETFs actually performed? The silent erosion of NAV. Let's dive into a little reality check. Not to be pessimistic, but because it's crucial to understand the difference between yield and total return. This is where many investors get tripped up. On the surface, these ETFs look like absolute rock stars. You see headlines like, ULTI yields 45%, or NVDY pays over 50% a year. And it's easy to think, this is the golden goose. But if you dig beneath the distribution numbers and look at actual NAV performance, the story changes quickly. Let's start with ULTI, the Tesla-focused fund. Since its inception, it's paid out sizable monthly distributions, often between 2% and 4% of NAV each month. But at the same time, its share price has declined steadily, especially during periods when Tesla has been volatile or weak. If you invested in ULTI right after launch and held it for 6-8 months, you may have received 20-30% in distributions. But your underlying capital might have dropped by nearly the same amount, or more. NVDY paints a similar picture. Despite Nvidia's insane rally in early 2024, NVDY underperformed dramatically. Why? Because it sold call options that capped its ability to ride that upside. Nvidia went vertical, and NVDY just trickled along, sending out high payouts but barely moving in price, and in some months even declining in NAV despite Nvidia gaining. That's the covered call tax. You sacrifice upside for income, and sometimes the sacrifice is brutal. Even YMAX and YMAG, which have broader exposure across tech giants, have not preserved NAV very well. Because they are constantly selling away future growth for income, they tend to grind sideways or downward over time. Sure, the distributions keep coming, but the base you're drawing from shrinks. That's the silent danger. Your capital slowly erodes while you're focused on monthly checks. Bottom line, these ETFs look great on a yield chart, but when you overlay total return, including NAV drawdown, it becomes clear that sustainability is an issue. You're not compounding, you're harvesting. Are the monthly distributions really income? Taxation and dividend classification. Let's move into a topic that doesn't get enough attention. Tax treatment. Those monthly distributions might look like dividends, but they don't behave like typical qualified dividends from stocks. Most of the income from these YieldMax ETFs, ULTI, PLTY, NVDY, MSTY and the others, comes from option premiums and derivative-related activity, not from owning actual dividend-paying stocks. So the cash they distribute isn't traditional dividend income. It's often classified as return of capital, short-term capital gains, or other income, depending on the structure. When it's classified as return of capital, it isn't taxed immediately. Instead, it reduces your cost basis, which defers the tax until you sell the ETF. That can be beneficial in the short term. But it also means your eventual capital gains bill might be larger when you exit. If the distributions are short-term capital gains, they're taxed at your ordinary income rate, not at the lower qualified dividend rate. That can hurt, especially if you're in a higher tax bracket. In some cases, the funds may report part of the distribution as non-qualified dividends, again taxed at regular income rates. The important takeaway? You might owe more tax than you think, and the true after-tax yield could be significantly lower than advertised. Let's say you're in the 35% tax bracket, and you receive a 40% distribution from one of these funds. If most of that is short-term gain or other income, your net after-tax return could be closer to 26%. Still solid, but a big difference from the headline number. This is why many investors prefer to hold these in tax-advantaged accounts like a Roth IRA, where the income and future growth can be tax-free, a traditional IRA, where the income is tax-deferred, a SIPP for UK investors, or similar retirement wrapper via a limited company. In these accounts, you don't have to worry about monthly tax events. The income just piles up or can be reinvested without generating a tax bill. Distribution patterns. Are the payouts stable? Another subtle risk is distribution variability. These ETFs don't pay a fixed dividend. Instead, the monthly payout depends entirely on how much premium they're able to collect from selling options that month. That means distributions can fluctuate, sometimes sharply. In a month where market volatility is high and option premiums are rich, you might get a 3.5% payout. But in a low volatility month, where traders aren't paying up for options, you might only get 1.8% or 2.2%. And if the underlying stock crashes, and the ETF is forced to reset its synthetic exposure at lower prices, the distribution could drop materially, at least temporarily. So while the headline yield might say 40% or more, the actual monthly dollar amount isn't guaranteed. It can and does change based on market conditions. Should you drip or take the cash? If you're treating these funds as an income engine, to fund lifestyle expenses, pay bills, or top off your monthly cash flow, then taking the income as cash makes sense. But you also have to be okay with your capital slowly declining over time in exchange for that cash. If you're looking to reinvest the distributions through a drip, you need to ask yourself, am I compounding income, or just cycling cash into a shrinking asset? In many cases, reinvesting into these ETFs simply adds to your exposure to NAV decay. You're putting money back into something that's not designed for long-term growth. It's designed to pay out, not build up. Final wrap-up, the real role of high-yield ETFs like ULTI, PLTY, and MSTY. These ETFs are tools, not miracles. They're designed to extract income from volatile stocks by synthetically selling covered calls. And they do it well. That's why you see those 30%, 40%, even 50% plus yields. They're real. But they're not free. The trade-off is, you give up nearly all your price upside. You take on NAV drawdown risk. You might owe higher taxes than you expected, and the income isn't consistent or guaranteed. These aren't core holdings. They're niche income weapons, useful in the right hands, but potentially dangerous in the wrong context. YieldMax funds, including ULTI, PLTY, NVDY, YMAX, YMAG, and even MSTY, are about harvesting now, not growing later. Know the difference, and use them accordingly.